Welcome to Real Cash Flow, the only show that takes you full circle with your money, covering stocks, bonds, commodities, currencies, crypto, insurance, and real estate. I'm your host, Andrew Michael Arroyo. Let's get started. Welcome. Today we are here with Richard Hall. And Richard is a real estate agent that is considering joining AARE. He's actually a commercial broker. He spent most of his career in commercial, and he lives in Texas. He has fantastic questions about syndications. And because he asked such brilliant questions, I thought it would be best to share this interview with our audience at large. Many of them are the same questions that so many people have when they're pursuing syndication, trying to understand how it all works, how they can participate in becoming an investment manager. And what I love about this interview, and you're going to hear it from Richard, and I've heard it from countless agents across the country, is the fact that AARE is the only brokerage out there that is offering this opportunity. Are there syndications happening? Of course there are, all over the country. But is there a brokerage that is allowing agents, brokers, whether they're residential or commercial or in property management, to be mentored and discipled to learn the fundamentals of how to manage an investment syndication and how to benefit financially and to profit from being a manager? And most importantly, putting your hard-earned money to work to receive an investment return, not being just a commission-based agent, but learning how to invest in the assets and in the properties that you're selling to your clients each and every day. So without further ado, let's dig into the interview.
Sure, thanks. Yeah, so syndication is definitely a strong interest. I'm involved as a limited partner and have been for probably over 10 years on a hotel in Silicon Valley that we built. Just a limited on it, but it's performed very well. Of course, Silicon Valley has had such a strong economic base, and even during the pandemic, it suffered, but we didn't have any cash distributions, but we're all cash flow positive, had all of our capital returned.
Oh, that's
and
nice.
I've worked at several companies that the principals had active syndication roles where they were raising money, but typically it was for their own client base. The agents could bring properties to them that they might have an interest in syndicating, but they weren't necessarily inviting the agents or encouraging the agents to be a part of it. Certainly, if somebody brought it to the table, they probably would be a little more encouraging of that. But thinking that syndication is, I won't say it's the missing link, but I think, as practitioners in real estate, whether we're residential or commercial, a lot of times we serve our clients at such a high level and so consistently, and the businesses can keep you busy 24/7 that you don't think about your own financial well-being other than the next commission. And to create passive or legacy sort of income, you really need to invest. And while we pay lip service to it in the industry, it's not always a practice that's taught on how to invest or how to partner with people. And syndication is such a great vehicle for doing that. And it has a high barrier of entry because of the legal aspects and the SEC potentially. So I think having that focus was very encouraging to me when John first approached me and mentioned it, and now Michael. So I'm appreciative of you taking some time to do that, because I think even though we are going through a transition now, I think both residential and commercial agents should take this time to both learn and kind of plan for their future strategically. And I think syndications gives them a way to participate even in a passive role that gives them tax benefits and income. And certainly there's always opportunities in any market to find things. It's a little bit harder maybe when things are peak price to see an opportunity. But I've been in Austin for 20 years, and there's never been a time, good times or bad, that people didn't say Austin's overpriced. So having lived and grown up in California, I've heard that sort of mantra for a long time, that markets are overpriced. But anybody that paid the top dollar 5 or 10 years ago in Austin are really feeling pretty blessed now. So And I know that was the case in California for pretty much throughout time. There's certainly markets like Las Vegas or Detroit or other places that have had some pretty strong corrections. But so my interest in the syndication is knowing a little bit about what your or the company's thoughts are on how it might encourage the agents to be active, whether both putting funds in it or maybe bringing deals to the table. But also, I guess, how it might look for me, maybe in bringing a deal and participating, what the company's role would be, what my role would be.
What agents have desired, I think, for many, many years is a brokerage that does give them the opportunity to not only be a real estate agent, whether that's commercial, residential, property management, but also to become their own investor and to learn the next level of real estate investing, which typically is managing a syndication. So we've been on the forefront of educating and training and teaching our agents how to do this. It's not for everybody, but even if they educate for themselves and then decide they just want to be a limited partner, well, at least they're a more informed and educated limited partner. And if they do decide that they do want to pursue the managing member role, well, they have an infrastructure to do it. And to your point, if you bring us a transaction, well, absolutely, that's raising your hand if you want to be a managing member because you're bringing an asset to the table, so you can participate that way. But even if you didn't bring the deal to the table, if you have a unique skill set, you've got that God-given talent to oversee assets for others and return capital, then you can be part of the management groups that we're developing in every area. What we feel is the most important is that people align with two other managers in their backyard so that they can focus on their own local market and they can execute where they know their backyard the best. And the perfect blend of a managing member team, in my professional opinion, is one managing member who's responsible for the administration, the regulation, the oversight, the auditing, the accounting stuff that people don't want to deal with because, frankly, that's not as fun as underwriting and buying and selling and transacting. So, and that's what AARE brings to the table. Today, that's me. So, I'm one of the managing members in that trio that I mentioned. The second managing member, which is typically a local that is very familiar with the market, is underwriting the transactions, going and finding the deal flow, spotting the investment opportunities, and they're many times also focused on, after the acquisition's done, either overseeing the property management or actually doing the property management to make sure that the asset yields the projected return. The third managing member, and sometimes this second and third position could be filled by one unique individual, but they'd have to be very well connected and a very efficient individual, is the third person is really responsible for fundraising and investor relations. Because if you're going to grow it big enough and substantial enough, you really do need a focus there. And that person's on the phones, they're communicating with investors, they're answering questions, they're walking them through the investment process, making sure that the subscriptions come in and the funds are deployed properly. And they're also going out raising more capital or new capital if we're going to expand the syndication and be more like an open-ended fund. So that's the essence of the managing member group. Again, I think when you get past three people, you get too many chefs in the kitchen and no one can decide what they're trying to cook. But if you can stay within that 2 to 3 managers, again, AARE will be one of those managers with you. That has been proven to be very successful. As far as the limited partners, or if it's an LLC, those, members, those can range anywhere from 5 individuals to 99 individuals. It's really just the capacity of that managing member group and how many investors they really want to deal with and how big the average investor will be. So for a crowdfunding project, they just recently raised the limit from $1 million to $5 million. That gives us the ability for, let's say, 20 investors to come in with, $250,000 bucks and then we can go finance another 5 million. So we can go buy a $10 million building, leverage 50% of it, and we only have 20 investors that we're responsible to administrate. So that is a sweet spot right now, I think. And $250,000 is a nice round number. Now, let's say you don't have that network where people are writing $250,000 checks, but your network could write $25,000 checks. Okay, well, then you're going to need 200 people, right? Not 20 people. So big difference, right? And you can do half of that. You could do, LLCs are designed for 99 members. Once you go over 100, you become a real estate investment trust, fall under different regulations. So we'd really, truly like to cap it at 99. There is workaround strategies where if you reach 99, you could start a second fund and start placing those people into that second fund. But I've found that, that's a lot of quote unquote shareholders or limited partners to be working with. The cap in my mind is more like 50 people. I think you want to be somewhere between, 20 and 50 people at a max.
Yeah. When you have, the more investors you have, the more management intensity there is. So, people get married, they divorce, they die, they have bankruptcy, or they just have questions about their retirement or something. And so somebody's got to be there administratively, whether it is the managing member, you have an outside third-party firm or something. Do you envision having a platform? You're mentioning Regulation A crowdfunding. Most of what I've been involved with is 506B. Or 506C. A lot of multifamily deals seem to be in one or the other. Of course, the crowdfunding sites like CrowdStreet are doing the Regulation A and things as well. But the platform can be very helpful in terms of administering, the K1s and some of the back end things where people can check their accounts, or you can see financial statements that are issued on the property. There's a number of those platforms that have come out. I don't know if migrated to that point where
yes,
there's IMS or Syndication Pro or Cash Flow Portal or some of the ones that I'm familiar with, but it may not be quite at that point, or you may have your own system. I don't know.
So to answer your question, both. We've been familiar with platforms for several years. I have a good friend who's developed an incredible platform specifically for Reg A, Reg CF, Reg D, all the ones you mentioned. And what's unique about his platform is that it's tokenized. So you have the ability to be on the blockchain. So it doesn't mean you have to do cryptocurrency or any of this weird stuff or have digital wallets. You can if you want to. We don't prefer to participate in that. And I think most real estate investors do not prefer to be that. But they're very cognizant of the fact that blockchain is the future as far as record keeping. And for that reason, he was the first to get the SEC registration for a tokenized platform. And it's not as well known as some of the ones you mentioned, but for our purpose, especially since we know the founder, it's quite unique, and we have a golden opportunity. Prior to this, I was utilizing, there's several of them out there, but there's escrow companies that most of the ones you mentioned, they're partnered with these escrow companies. So they're really white labeling their software. Because of our investment advisor background, we kind of cut out the middleman. So we don't have to pay those crazy fees on those crowdfunding sites, like 7%, 10%. And deal directly with the escrow companies, which actually own the software. So that's quite nice. We keep our fees to a minimum. It keeps us compliant with the SEC for the Know Your Client, KYC, and AML, which is all background checks to make sure that the funds are coming from a valid, legitimate source. And it also keeps, as you mentioned, our administration processes to a minimum, because they have their own login, so they can get their K1s and they can, see their account. If they're invested in multiple different entities, they have a dashboard to see that. So, we're ahead of the curve there. It's really a timing thing at this stage, just watching the market cycle to press go. We have a lot of people that are patiently awaiting this change in prices with the interest rate movements. So yeah, and finding the managers, because what I've found is unless you have the right team in place, it's better just to wait rather than execute, even if you see a great deal, if you don't have local boots on the ground. So we have all that in California and, into some of the Southwest states, but in some of the states, we're still growing into. And that's why we're inviting people to participate in the firm. We do ask that they are here if they're going to participate in the syndications, because if they have 1 foot in and 1 foot out, right, they're doing their brokerage business somewhere else and their syndication business here, it creates some client confusion, some extra liability, and we want people to be all in.
Sure. No, definitely concur with that. Is there any thought about restricting one's activities between brokerage and syndication, or guidelines to that degree, or is that left up to the agent or broker? Or
yeah, it really boils down to what level of participation that they want to take on. I think if they're in a financial standpoint in their own lives where they don't depend on sales, I think they would be better off focusing exclusively on syndication, potentially moving into a Series 65 license, which I have personally, which gives you more credibility and really keeps you on the right side of the law. There is ways you can put together real estate syndications without a securities license, but like you said, it's a Reg D offering. It limits you. Let's put it that way. And there's brokers out there that they're not, at that financial standpoint in their life where they could give up their sales to exclusively focus on syndication. But we are seeking individuals that are at that life stage to ramp up with us, because the demand is there, the clientele is there, the money's there, the talent is there. Now it's just organizing it in a brokerage environment, which has never been done before. As you mentioned, some of the principals usually participate in some syndication. Some of the commercial firms have some syndication arms, but there's not the equal opportunity for people to learn and enter into the syndication space. And that is what AARE is offering.
So has there been any syndications under the AARE umbrella, or most of it's things that you've done privately or the other principals have done? Or
correct. No, it's all been private, and myself or the agents that did work here. And then we went ahead and, formed our own LLCs and did our own ventures. But no, this is a moving forward. I made a personal decision that I was going to syndicate and use my talents inside the agency, because I could keep doing it by myself and with my family, so on and so forth. That doesn't help the balance sheet or the income of the publicly traded company, right? That would benefit just me, but my whole mission in life is one, to be generous and to build this organization that would benefit others. So I've decided that, I'm going to put my wisdom, talent, knowledge into the syndication as one of those managing members, and that will benefit the corporation. And moving forward, these new syndications that we set up, they will, be under the AARE umbrella.
Will be like a subsidiary or division of some sort, perhaps, or
perhaps, yeah. I mean, basically, the way that the entities are set up, you have a capital LLC for the LPs to invest in, and then you have a management LLC for the managing members to participate in. And one of those managing members of that LLC will be the actual corporation, which will be technically me at this stage until I can train people to want to take on that role. But, we'll have a third or more. It just depends. But I like a third, because it gives people the ownership partner feeling, right? If I've got two other managing members and they know they own a third of that series LLC, that's exciting. I mean, that's their baby, and they've got maybe another person that's local they love working with, and with my knowledge on the back end of the administration, regulation, SEC, the audit, that's kind of the perfect trio. And I did prove it out to answer your question completely. I didn't just walk out with a vision and say, let's just go for it. I took a group of agents about 4.5 years ago now, internally at AARE in Southern California. And I told them the vision. I said, this is what we're going to do, but we're going to prove this out. You're going to be the beta test. We pooled our capital together. They had to have skin in the game. That was part of my requirement. And I asked for anywhere, the very low end, about 25,000, but really we were looking for 50, 100, 200,000. And on average, people had about 100 to 150,000, but it was a small group. I think there was 6 or 7 of us total. We had a couple members come and go, kind of need the capital and have to trade in and out. But the vast majority of the group, the core 5 people, they stayed. And there was 2 main managers, and they focused on just buying, fixing, flipping, kind of, either single family, 2 to 4 units. It wasn't even getting to the multifamily space, but they were so talented at what they did. And I told them, I said, look, I'm going to be the silent investor that's just educating you, but you really have to do it yourself. That's the only way you're going to learn. And they did such a great job. They turned, I think, initially about 800,000 in capital, and they kept parlaying this and buying and selling and growing. And the last purchase they made, which was right during COVID, before the boom. So they caught that and they didn't make any other purchases. We stopped, thankfully, before the market turned. They had rallied it up to about 2.2 million in equity. It was a self-directed fund, all IRA money. So there's no loans, there was no liability, no leverage. And those were phenomenal returns in a 4 to 5 year period. Now they purchased a vacation rental, a block off the beach in a city called Carlsbad, California, very desirable. They do the Airbnb, VRBO, and they have lifetime income for the rest of their lives, an outright owned asset. That's you can build 3 or 4 units. I think it's R3 or R4. So there's, they're going to put an ADU on it coming up here. So it really is the case study, taking 800,000 up to 2.2 and providing now a lifetime income with potential for development in the future and an education throughout the whole journey.
Sure. That's great. Wonderful results. How would it look, I guess, maybe procedurally? I found a deal, say the example is I found maybe a small commercial property or a multifamily. I would bring it to you or the executive team. If they concurred that it was a possible target, then you would kind of start the machinery going, maybe with legal as far as what an offering might look like at some point. How would that process in your mind kind of proceed at that point?
You got it. And we'll make sure, Michael, to send out Richard our 12 steps to syndication, because I got it on one sheet so that people can see the very basic steps. There's a training program that goes along with it. But to answer your question, yes, the first thing is the design really of what it is that you want to offer. And is that something that you want to go asset by asset, or do you want an open-ended fund? And if it's just one asset, that's technically a syndication. If it's an open-ended fund, that means we're going to be buying and selling multiple properties, and we have to have redemption periods, either monthly or quarterly, where people can come in and out of the fund. But let's say it was a syndication. Yes. And let's say that we underwrote the asset and it qualified. It had a good opportunity for a great ROI. Then the next steps would be to go ahead and formalize the legal documents, the PPM, private placement memorandum, if we're going to go with a Regulation D, or if we're going to go with CF, then just the offering circular. Reg A is a little bit more complicated. That's about a 6-month process with the SEC. We've got that minimized because I have a lot of those intellectual assets, right? The templates where I can get the fast track and hopefully get it done in 3 months. But let's just say it was a crowdfunding opportunity, then we can turn those around in less than 7 days at this point. And that's where a lot of groundwork has been put into the efficiency with the platform, the systems, and the SEC filings that need to take place. and off to the races we go. So, and we have to, do some what's called testing the waters, because you want to make sure you can actually fund this investment. And that's the nice thing about crowdfunding and some of the 506 offerings that you mentioned. They have their own regulations on advertising, but Reg A also allows testing the waters. So before we go spend a lot of money and effort and time, sometimes it's best just to see if there's an appetite for this investment. And that can be simple, photograph. If we need to keep the address confidential, let's say it's an off-market listing, we can do that. We can do renditions rather than real-world photos, but then we can give a description on what exactly the investment opportunity is, start circulating that, testing the waters, see if there's an appetite, and if we're going to reach our minimum raise. And our minimum raise would typically be, let's say on a multifamily building, 35%. So that's usually what the LTV needs to be in order to obtain the loan. And as long as we feel confident that, yep, we have some soft commitments for that 35%, then off we go. We go ahead and publish it on the platform and recall our list that had given us those soft commitments and ask for the funding.
And then as far as any loan guarantees, either one or all of the three managing members that we would maybe propose to kind of quarterback the offering would be signing personally, typically on these loans. But if there was an outside key principal guarantor, that's a possibility that we could bring in whatever credit, so to speak, financial strength we need as an outside.
We want to avoid the personal guarantees and go for the non-recourse loans. And that's where with residential, you don't have that opportunity. So if it's 5 units or more, and we have a strong enough asset that is yielding good cash, we should be able to obtain a non-recourse loan. And that way, none of us are guaranteeing the payments. That is the ideal scenario. So that takes the right lender and takes the right asset, because then they're underwriting the asset itself, and the asset itself stands on its own legs, and they're not depending on our credit worthiness. They're actually looking at the cash flow from that asset. And as long as we have enough down, they're going to feel comfortable to allow that.
Yeah, I might have misspoke a little. Certainly guarantee can be an issue on some commercial loans. I guess it was more the net worth requirement. Freddie and Fannie Mae have net worth requirements equal to the loan. So if you're borrowing, say, $3 or $4 million from them, then somebody, or the total net worth of the parties, have to equal that or higher, and certain liquidity, of course, standards as well. But
correct.
Sometimes I'm seeing a lot of syndication efforts where they'll have 2 or 3 GPs as the general partners, but they'll bring in a key principal that's somebody that has the net worth and maybe the experience. They want somebody that has multifamily, in the case of the agency lenders, to sign on that. So
you're spot on. You're spot on. Yep. So that is an important consideration, especially as you get to the larger transactions. I think, on these 1 to 5 million, there's, enough people usually in the group that will satisfy that. But if you're going to take down a Reg A offering at $75 million, which is the cap now, you're going to need one of those key principals, because that's a big transaction. That's going to go to the highest approval before they're going to sign off on one of those loans. And the other thing to consider is so many people are focused on these leveraged opportunities. What I feel is the biggest opportunity for all of us is the self-directed IRA money that's out there. And that's been very successful. We don't want to leverage those because of UBTI and the tax complications. And people have the benefit, especially if it's in a Roth IRA, of not paying taxes on exit. I mean, that's really the dream there. And so I've personally got my Roth IRA to that point, and I've helped others. But even if it's a traditional IRA or 401k, great place to start. You can build it up and then potentially roll it over to the Roth, pay some taxes, and then know that you can continue to grow that Roth now with these events.
Yeah, it's interesting when I talk to some of the custodians on some of these self-directed companies, they say there's hundreds of millions of dollars that are just sitting in cash in these accounts. Because even though it's self-directed, people don't always take the initiative or the effort to really understand where they should put their money. And inertia seems to rule out that they have it sitting there. So if there was an educational component that allowed them to see, hey, the stock market's been pretty variable or volatile this year, down 20% or more, you might want to consider real estate as a portion of your holdings. So I think there's a lot of opportunity with the self-directed funds to be able to really put that money to work at a pretty safe risk-adjusted basis.
Yes, absolutely. And I would say the barrier to entry has been such an issue in the past for so many of these people wanting to get into multifamily or syndication, because if they can't write a check or have the net worth that you're describing, they're out. You need to be accredited, million or more beyond your own personal residence. That's a lot of people don't have that. They might be worth a million or two, but a million's wrapped up in their personal residence and equity. And but with the crowdfunding and, Reg A, they can come in, 25,000, 50,000. They have what's called the 10% rule. So as long as they don't exceed 10% of their income or their net worth, then they're okay. They can be non-accredited. So that really opens up the space, because there's a tremendous amount of people that have net worth between, let's say, 500,000 and $1 million, that they could write that check for 50 to 100 grand. But prior, if they were ethical and were answering that accredited investor question honestly, they couldn't write that check.
Right.
So that, I think, is tremendous. And the real estate agents, their clients, so many of them can also write $25,000 checks. And you add all those up, as I said, a little bit more administration. But if it's self-directed dollars, most people are not going to tap into their retirement because they need something next week. And so it seems to be a little bit more sticky capital.
Very true. Minutes, this has been a wonderful call, and I really appreciate the opportunity to kind of further explore that, and certainly the opportunity with AARE. Since the beginning, starting with John, I've just been impressed with the culture and the structure, and of course, you all on the executive team as well.
Well, you've asked all the right questions, so we appreciate you so much. I wish people would take the time and care and understanding to see this opportunity like you have, because this is the future. It's here today. And for those that can harness the future and are willing to be mentored and learn this new aspect, it's going to have profound impact, as you mentioned, on the longevity, their own personal investments, their retirement, and their well-being. So thank you for everything.
Definitely. Thank you.